Now, when we look at what has happened so far in the global market, we want to look at how have things changed on the water first, because that's when where you're going to see the biggest impact from Russia in terms of their ability to export into the open ocean. And those are some of the important shifts. Where are we on that front? How much is that adjusting so far? And will we continue to see that adjust? And those are the different pieces. So the drop in crude oil on the water is really coming from a mixture of things. You still have crude that's floating, but some of it has started to come on shore. The tightness that has been created within Europe is keeping things moving straight on shore, not keeping it in a boat. But you can see we're still at 2020 levels. And so you're still at very elevated levels. So once you take that out, you're still at that seasonally adjusted high. And you're going to stay there just given the amount of crude that is still in the water. And that is a mixture between what is in transit versus what is in floating storage. Now, the floating storage one is the one to watch the most. And we'll talk more about this at the end, because you want to look at the Middle East and West Africa, because the Middle East prices off of Oman, Dubai. So realistically, if you have a choice, you're going to not buy West Africa first. You're going to buy Middle East first, because it's at almost a $9 discount to dated Brent. So I'd rather buy that because I will get a discount versus buying something that prices off of dated Brent, which is West Africa. So, and you haven't seen a lot of movement, but tightness in the market means that you'll pay any price. And you haven't seen that panic yet. Now, I'm not saying that you won't see it, especially as you have refiners starting to come out of maintenance season. But that's going to be the important piece. Where are we as refiners come out? Are refiners going to look at this and be like, wow, we were expecting things to improve prior to getting aggressive. We don't have that luxury now. And then that will start to see some of this tightness. And that's going to be kind of that important pivot to see, because then that would give way more strength to the futures market, where right now you have a lot of macro in it. You have a lot of uncertainty with inflation. We have the Fed rates announcement today. So again, you're going to have a lot of this back and forth. But until you get some of that tightness in the physical floating side, you're just going to be subject to a lot of volatility, and it's just going to come down to where things are, which is why we like to talk about the physical and how it compares to what's happening in the paper world. So then when we look at what is the crude in transit, you can see that crude in transit is starting to come down. You're starting to see some of these cargoes offload. There's a rush to get some of these Russian cargoes that were already purchased offloaded. We saw what happened when Shell decided to buy a Urals cargo because the discount was too juicy for them, creating its own issues. But again, those are some of the pieces where oil in transit, it's below where we were in 2020, but still very elevated. And that's going to be because, remember, we also have the OPEC agreement. So OPEC agreement is putting another 400,000 barrels, allowing a potential another 400,000 barrels on the water. Doesn't mean we'll get there, especially from West Africa, because West Africa has been unable to clear a reduced level. So they have room to go up. Again, I think that if you want to get into a back and forth on spare capacity, I think West Africa has less spare capacity than is expected, where I think Middle East has more spare capacity than what is expected. So it's more of like a balancing act, and Libya is now pushing for a bit more flow. And Libya is actually a good kind of replacement for where Urals are, especially obviously into the Mediterranean. So it's just going to be, there's still back and forth on who's going to become the next prime minister. There's two militaries are essentially staring at each other. So far, things are tense, but movable, still coexisting, and we can hope that continues, because if it doesn't, that could obviously take another, anywhere from 500 to 1 million barrels out of the market. Just depending on what areas are impacted. And then there's Iran, because Iran, we were in the middle of trying to bring some of this back, still trying to increase some of our relationships with them, allowing them to export, but then they obviously launched those missiles. And to be very clear, they weren't rockets, they were missiles. Rockets are something that doesn't have an intelligence about them. They're just something where the rocket goes where you point it, where missiles have homing devices, they have GPS, they're more sophisticated. So that's why it is important to understand that they were ballistic missiles. They did hit the target they were looking for. And it's just going to be, well, do you want to go and do deals with them? So Iran is just using this because they know the world is kind of, do you want the refiners to start to panic? Because that's when you start to get some of these fears. Or do you want to kind of get in front of that? And they're playing the cards that they have. And the fact that Russia is being sanctioned and Russian crude is coming under pressure opens up some opportunity for them. Now, when we look at floating storage, you can see that floating storage has been fairly flat. And as cargoes get pulled in, it's being replaced by what is coming into transit, which is why that transition from transit to floating. Now, the bigger issue is going to be China as we get those additional shutdowns and closures. Some of them are at sizable ports. So when you look at Asia, we should actually see a fairly big increase in Asian floating storage. And that should keep us above where we were in 2021, and that's going to be an important one to watch as we go forward. Now, when you look at the U.S., just to start with crude, as you know, we've been saying that we should be holding around 3 million barrels a day of exports, and that's speaking on the 4-week rolling average, just because it's a bit lumpy, just because we have the Houston Ship Channel. It's fairly narrow. Some of the areas we have to use lightering, which means that you have to take a smaller vessel, fill it up, and then put use that vessel to fill up a bigger vessel, and to do that several times. So because of that, there's just timing. So that's why the 4-week rolling average, again, we're confident with that 2.9 to 3, probably even closer to 3.1 based on some of the data that we've seen coming out on the additional purchases from Europe. Gasoline had a big pop of 113,000 barrels a day. That's now 45,000 above the 5-year average. Now, distillate was the shocker. 341,000 barrels a day increase. That's 306,000 above the 5-year. There could be some pent up demand in that. There pent up movements because of just timing, but there's also a lot of money to be made in diesel. And if you're looking at the U.S. and saying, well, it's starting to get a bit warmer, we're not going to need as much diesel, you're going to try to hit that bid, take that offer as quickly as possible. And these are the different pieces when you have the different movements. So again, this is really driving things higher. So we could see that remain a bit elevated. Propane, the LPG, still strong, came down a bit, but still 227,000 barrels above the 5-year average. So here's gasoline. We're back above. We increased. There's also that balancing act because gasoline does start to go bad. So you want to make sure that things are fairly balanced. We are coming into that winter into summer kind of flip. So you also look to try to get rid of some of the excess winter that you may not need. Try to, again, because you really don't want to keep that winter grade for next year. So a winter grade is really on a blending side, but if you have higher quality gasoline, you can make a bit more money. So again, they're just trying to manage their storage in terms of what type of gasoline is there. Is it 80, 83 RON? Is it 87? Is it 95? They want to try to manage some of this to make sure that there's enough available going into summer. Distillate here, you can see that nice little spike. You can see just how sizable it was. As you know, we've been saying that we were going to kind of bump along the bottom, below the 5-year average, above but stay in the low end of the cloud. We think that does happen. It does come back. But we'll have to see if this is something that people are just trying to take advantage of international prices. Ethane can't stop, won't stop. It'll continue to stay strong. The only way it would really start to come down is if China slows down some purchases because of the lockdowns. So far we don't think that is the case. And if it is, it'll take a couple weeks for it to really start to hit. But seasonally speaking, we normally come into a slow period. So we don't see too much change at this point, and we still think it'll be at new all-time highs. Crude oil exports, as you're seeing, kind of at that elevated level, and more importantly, sitting here at just at that 2.9 to 3 million barrels, likely to shift a bit higher to about 3.1 million. LPG, you can see still elevated, still strong, still going to stay elevated, especially when you look at India, what's going into India. LPG still has a very healthy home flowing into that market. Now, when you look at Dubai versus Brent, it's come down a bit. It's at about 850, anywhere between 830 and 850, depending on the last time I looked. I think when I looked earlier, it was 855. When I looked before I started filming this, it was at 833. So again, it's above $8. It's come well off of its 20. It was just over 20. I think it was 2033. But you can still see going back through 2016, it's still at a massive spread. So it's still going to incentivize more purchases from the Middle East, less from the other areas, in order to try to balance some of these different flows. Now, when you look at margins, so we typically use euro margins in Europe. Clearly, we can't do that right now, but you can see that shock in terms of where things are on the different margin side. Now, this doesn't really capture LNG prices and natural gas prices and some of the cost. So costs have continued to go up. So even though the margins look better, it's still not where it needs to be. And they've actually started to weaken as some of the demand has continued to diminish. It's still strong on the hydrocracking side because there's still that middle distillate demand, but we're not seeing the same type of demand on the light distillate side or gasoline and the heavy disti resid side. So they're going to try to target that middle, which is why, in theory, given the amount of of distillates that come out of West Africa, you would assume that would be some of those demands. But instead, there's a bit more being sourced, obviously, from the Middle East as well as from Latin America. So this just puts it into perspective. I wanted to go back a bit to see where have we been here before, and you can see that this green line is 2008. So we've been here. It's just a matter of what the last time we were here. This is some of the different pieces that we're seeing, and we expect it to continue to come under pressure, but obviously still remain fairly well bid. Now, when you look at some of the different shifts, you can see that Russia had about 4.196 million slated for March exports. They're typically the last to sell. So when you look at where they are, they're kind of on the back end. Some of those cargoes will get stuck, which is why you're starting to see some of those really broad discounts. But then when you start looking at other areas, Nigeria, Angola, you're starting to see, again, they're picking up just a bit. And then when you look at Libya is sitting at just over 1 million. And so far, we expect it to stay at about 1 million. Angola just put out their numbers for May. It's fairly consistent to April. So we don't see too much shift right now. That could get upsized if we start to see some of that floating storage coming down. But right now, Senegal has reduced its offer for its last April cargo. So again, they're not in any hurry because they're still struggling to clear April. And then for Senegal, there's still cargoes in the trading. It's still crazy to have the pieces here, but China's also offering 3 cargoes as a reoffer with no interest. So not only is Senegal trying to sell, but so there's really 4 cargoes that are available in April, which is very, very rare for this time of year, for this time of the cycle. Not to say that it can't get sopped up, but they're also trying to play a game. They don't want to just try to compete too much. They want to try to find and come down, gradually. Pricing in Europe still remains high. As we talked about with dated Brent, that's not something that we've seen. We're not going to stop seeing. Euros traded at over a $30 discount when you look at what was being pushed through. And then when we look at what's happening with CPC, that continues to be at extensive discounts. The last one that we saw was at almost upwards to about $13. It has tightened up a bit just because CPC blend to Asia are set to rise to about 14 million barrels. So it's a replacement for some of the Russian barrels. So again, you're still seeing some of those discounts, but it's starting to tighten up. And then when you look at ESPO and SOCOL, we don't have pricing yet, but we are starting to see some talk because they're removing the need for letters of credit in order to try to bring on additional Chinese buying. Now, there was a lot of talk about the trade, that we do think that there will be a trade between China and Russia, India and Russia, and it'll be using a fixed rate. Now, there was also talk about Saudi Arabia and them accepting yuan payment. Now, that's fine in terms of where things are, but I think it's important to appreciate what is actually happening. So the Saudi currency is still pegged to the dollar. So even though they're going to get paid in yuan, they're still buying it in dollars and just paying the equivalent. So it's not like the whole transaction is happening in yuan. It's just they're accepting something other than dollars, but still compared to the dollar exchange rate. So they're just getting, instead of dollars, they're getting dollar equivalent in a different currency. So I think that there's still a lot to hash out. It's still a large number. In order for Saudi Arabia to maintain the peg, you have to be able to buy and sell dollars actively in the market. So to take in less dollars is going to make it more difficult, because when you're selling crude in dollars and taking in dollars, you're naturally replenishing what's going into your treasury. So, but if you're now settling, offering it in dollars, accepting it in yuan, you then have to go immediately out and convert that yuan into dollars. So it's kind of adding an extra step. So there's going to be something to look at and to see what they're trying to game, or is it more of like a shot across the bow because, let's just say this administration hasn't been too friendly to some of the entities in the GCC. And that is this just kind of like, this is what we can do, not to say that it's actually going to come to fruition. So then just some of the updates, Angola, I just wanted to pull up the actual number. Oil exports in May are set at 1.14 million barrels per day. In April, they were 1.15. So again, there's still some flexibility in terms of where that final number will shake out. Genscape still remains, there was a small build, but you can still see it's well below seasonal norms. And that's going to continue to be the case as again, Urals becomes the biggest issue in that replacement factor. When we look at the different types of products within Europe, there was a small decline in gas oil, so nothing too crazy on the gas oil front. I'm just pulling up the actual chart because I unfortunately forgot to replace that one, so I'm getting it now. So when we look at, there were draws in gasoline of 59 ton, 59 gas oil small, naphtha small build. So again, nothing too crazy, but again, you're starting to see some of these drops, and gas oil, we just expect it to remain at these levels. Then when you look at gasoline, here you can see gasoline had a drop, but still well above, with that seasonal norm, and you're kind of still bouncing around. You will see this come down a bit. Again, they're going to try to manage the levels of storage. And the reason why is because we're seeing more demand destruction in Europe than some of the other places. And again, that's going to put more in storage, so they will look to export more. Fuel oil, we should see some of this continue to flow west to east, going into the east, the Asian markets. But again, that's just going to be more about the different times in general. So now when we look at some of the different pieces going into Singapore, Singapore had a build coming very close to the seasonal norm, the seasonal average. We just expect it, as we've been saying, to kind of bump along sideways at this point in time. So when you look at light distillate, again, still still elevated. We expect this to continue to grind higher because emerging markets will get hit harder with some of the pricing on the inflation front. So we do expect this to drop a bit more. But on the middle distillate side, still going to be strong, still staying strong. And you can just see how far off we are in terms of the average, but we just expect it to go sideways at this point as they try to manage price. And as prices go up, they'll bring in more residual fuel. Now, resid, as you can see, bounced back up, still above the seasonal norm. We expect that to be the case, and as we continue to say, this is where they're going to go between the middle distillate and heavy disti and resid. So on the inventory front in Fujairah reported an increase of 814 barrels, 14,000 barrels. Light and middle posted some increases with the heavy resid staying flat. Middle distillate still very low. Light distillate increased 211,000 barrels. Asian gasoline complex strengthened March 16th on expectations that more gasoline export cargoes would be angled away from Asia toward the Middle East, reducing supply, exerting some pressure. But again, you're starting to see China decreasing gasoline exports moving into April. But you're still seeing a fairly sizable demand fall off in the other regions, which again is going to kind of offset this. So we expect it to come up a bit, but again, staying in that 6 million barrel range. Middle distillate had an increase of 600,000 barrels on the week from a record low of 1.703 million. And so when you look at the gas oil complex, it's softened a bit. Product cracks are easing in tandem with levels in the West as market participants eye evolving demand and supply cues from Asia. Gas oil cracks in Asia have been narrowing in line with slipping product cracks in Europe. So again, you're starting to see these shifts, and the product cracks are again coming back to some of that weakening demand that we've started to see. And it's not as much in the U.S. It's really started more aggressively in Asia, and you're starting to see something similar in Europe. Heavy resid increased 3,000 barrels, so fairly flat. The spread between Singapore and Fujairah was assessed at minus $39.97 a metric ton. So right now, product availability raised prices at the Middle Eastern bunker hub ahead of Singapore. So again, you're just seeing some of these different back and forths, but nothing too crazy at this point in time. The Brent time spread, you can see it's fallen back to about $2. It's still high, but again, it's not 450. So again, you're starting to see some of this normalize as we go through, and people kind of take stock of where we are on the demand front, where are we on supply demand, and you're starting to see some of this. We don't expect too much of a decline from here, but again, you're starting to see kind of this level off at this point. China's supertanker crude imports, it's flatlined, very seasonally normal at the upper end. This is going to kind of continue. The problem is, as there's issues at the port, you're going to see some of this get stuck because of lockdowns, which is going to send Asian floating storage back up. You can see it's right at where we were in 2021, and we expect it to now be above where we were in 2021. North Sea is at zero. We expect it to stay at zero as all of this crude is immediately purchased and pulled into the European markets. West Africa has come down as we did get some spot sales, but you can see that we're still at seasonally adjusted all-time highs, which is why we are still seeing some trimming on April exports. We're still stuck, and we're not seeing April clear the way it should, and there's still a lot of crude available. So the fact that Russia is willing to give such a steep discount and China and India are looking for discounts, that's again going to put more pressure on West African cargoes, and we don't see that improving. And now kind of a bit of a shock, but again, there's also timing delays. There's been an increase in Middle East floating storage. You want to see if this sticks, because we were expecting this to continue to fall and come actually closer to where we were in 2018, not where we were in 2017 or 2021. So we want to see how this kind of balances, because we do have more crude coming on the water because of the OPEC agreement. So this is going to be one, because this is going to be more indicative of how much slack is in the market, because this is going to be the preferred one, given the price differential between Oman, Dubai, and dated Brent. And so this would be the one that you would purchase first. So that's going to be a good indicator. European floating storage still remaining very low. We don't see that changing. And then when you look at China, refinery run rates have come down again. That's because demand has gotten worse. Additional lockdowns, which have created additional problems. So again, these are some of the things that we've been talking about on the demand front, especially out of Asia, which can kind of brunt a bit of the supply hit that we're going to get from some of those cargoes being stuck in the Black Sea and not able to get into the market. So if you have any questions, you can find me on Twitter in the comments section. Again, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.